Okay, guys, today I will continue in chapter 5 exercises. For the last lecture, we finalized exercise 5.5. And now let me start with 5.6, the break-even analysis. Mauro Products distributes a single product, a woven basket, whose selling price is $15 per unit and whose variable expense is $12 per unit. The company's monthly fixed expenses is $4,000, or expenses are $4,200. Required from the question, calculate the company's break-even point in unit sales. Calculate the company's break-even point in dollar sales. And if the company's fixed expenses increased by 600, what would be or become the new break-even point in the unit sales and dollar sales? Okay. Let's open a slide. No need for tables, then we need a normal slide. Exercise 5.6. And we need to prepare break-even point in unit sales. So break-even point in units is equal to what? The break-even points in units. What is required in is break-even in unit sales. So this is simply using the formula method, which is fixed expenses divided by the contribution margin. Okay, so this equals to, the fixed expenses are $4,200 divided by the contribution margin, which is the difference between the price 15 and the variable expense. So 15 minus 12, so 3. And the answer will be what? The answer is 4,200 divided by 3. This equals to 1,400 units. 1,400 units. Okay. This is for the first exercise. What is the break-even point in units? Number 2, we need Calculate the company's break-even point in dollar sign, in dollar sales. In dollar sales, we need to use the ratio, not the contribution margin. So the break-even point in dollar sales using also the formula method. So break-even point in dollar sales dollars equals the fixed costs divided by contribution margin ratio. In this case, we will use what? We will use the 4,200 divided by 15 minus 12 out of 15. So we need 3 out of 15. 3 out of 15. Or simply, we can say 1,400 times the price, which is 15. If we have it in units, then we can say 1,400 divided by, multiply by 15, which is a price. Okay, so the answer is 21,000. The 3 out of 15, this equals to 0.2. So 4,200 divided by 0.2, this equals to $21,000. Okay. Or, as I say, we do have, or the break-even point in units multiplied by the price. 1,400 multiplied by the $15. This equals to $21,000. Okay. Number 3, if the company's fixed expenses increase by 600, what would become the new break-even point in unit sales in dollar sales? Again, we can use the formula method or the equation method. So the new break-even point in unit sales, you like, we can use it. I will go back for the first question, then the break-even point hello. The fixed cost will be 4,800 divided by contribution margin is 3. Then the break-even point in units will equals to 1,600 units. 1,600 units. Okay. In dollar sign, then we will say break-even point sales dollars will equals to fixed cost divided by contribution margin ratio. In this case, this equals to what? 4,800 in this case, divided by 20 No change for the contribution margin ratio. So 0.2, 4,000. Uh, 4,800 divided by 4 thousands, or simply as I say, we can say the 6,000 times the price, which is 15, this equals to $24,000 directly. So this is question 5-6. Okay. Exercise 5-7, target profit analysis. Lin Corporation has a single product whose selling price is 120 per unit, and the variable expense is $80 per unit. The company's monthly fixed expenses is $50,000. Required calculate the unit sales needed to attain a target profit of $10,000. Now, for the target profit, remember that we need to add the target profit to the fixed expenses in order to get that target profit. What is the units to be sold? We need to add the target profit to the fixed cost in the formula method divided by the contribution margin. So calculate the unit sales needed to attain a target profit of $10,000. So we need to calculate it. We can calculate it in two ways: the equation method or formula method. Okay, formula method or equation method. If we follow the equation method, then we can say, let's open a slide. If we follow the formula method, this will be five, 7. Formula method means profit equals to contribution margin Q minus total fixed costs. If you remember from the beginning, that total contribution margin, which means the sales minus the total variable cost, we can say Q price, which will represent the sales, minus QV, which represent the total variable cost, and V minus P, P minus V refers to the contribution margin. So we can say Q multiplied by CM, which is contribution margin, all minus the fixed cost is equal to the profit. Okay. Now, the profit needed is $10,000. Okay. $10,000 equals we need to calculate the contribution margin. Contribution margin is the difference between the price and the variable cost. So 120 minus $80 all multiply by Q, which is missing in this case, all minus the fixed expenses, and the fixed expenses is what? Given to be 50,000 units, $50,000, $50,000, okay? $50,000. Now we can say 40 Q equals to 10,000 plus the 50. 10,000, if we move the 50 to the other side, then this would be 10,000 plus the 50,000. Okay, so Q will equals to what? 60,000 divided by 40, and this equals to 1,500 units. 1,500 units. This is the quantity to be sold in order to get that profit, which is 10,000. How many units do we need to sell in order to get that much of profit, which is the 50, the 10,000s, the 10,000s. Okay. In another way, we can calculate it in another way, which is the formula method. Formula method means that we need units equals to fixed expenses, target profit plus fixed expenses, all divided by contribution margin, all divided by contribution margin. Okay, so we can say this equals to target profit here is 10,000 plus fixed cost is 50,000, all divided by the contribution margin, which is 40 or 120 minus 80, right? So 60 again, 60,000 divided by 40, and this equals to 1,500 units. The second one is called the formula method. The first one is called the equation. If you like, we can equation method, and here it is formula method. Okay, formula method, which is simply the target profit plus the fixed cost divided all by the contribution margin. Okay, now the second question, calculate the dollar sales needed to attain a target profit of 15,000. 15,000. Again, we can calculate this question depending on the equation method or the formula method. Equation method or formula method. Same like the first question, we can do the second one, number 2, using the equation or using the formula. So I will start with the equation method. Equation means profits equals to what? CMQ, which is contribution margin total, minus the total fixed costs or fixed expenses. Then the profit, according to the question, we need 15,000, right? 15,000. The contribution margin is same, which is 120 minus 80, all multiplied by quantity, minus the fixed cost does not change, so it is 50. So here we can say the 40Q will be what? Equals to 15 plus 50. 15 plus 50, which is 65,000. So the Q is equal to what? 65,000 divided by 40. And this equals to 1,625 what? Units. By the way, we calculate it here by units, and then we can see the sales dollar to attain the 15,000 profit is equal to what? 1,625 times the $120. This equals to 195,000. That's why I prefer the formula. Maybe we will forget the last step for the solution here. That's why I prefer the formula method. Formula, no need to add a step. So the formula method means units to, no, the dollar sign, right? The sales dollar to attain that, to attain a profit is equal to what? Target profits plus fixed expenses, all divided by what? Divided by the contribution margin ratio. Be careful that we are using the ratio because of the sales dollars, right? Sales dollars. Then the target profit here is equal to what? This equals to target profit. We need it for 15,000 plus fixed cost is 50,000, all divided by the contribution margin ratio. The ratio is 40 out of 120. 40 out of 120. Okay. So 40 out of 120 is equal to 0.333. And then we need 65,000 divided by 0.333. This way equals to, if we use the full percentage, the full number for the contribution margin ratio. So 65,000 divided by 0.3 rounded. This equals to $195,000. Okay, so these are two methods to calculate the dollar sales needed to attain a target profit of 15,000. The formula and the equation method. Equation method, we need to calculate the quantity first and then multiply the number by the price. And then for the formula method, no need because we use the contribution margin instead. Good. 5.8. Molander Corporation is a distributor of a sun umbrella used at resort hotels. Data concerning the next month's budget appears below or appear below. We do have the selling price per unit, variable expense per unit, fixed expenses per month, unit sales per month, and that required what is the contribution of the company's margin of safety, So exercise 5.8 talking about the margin of safety. And just to remember, for what is the margin of safety, it is the excess from the sales for the break-even. So the difference between the actual sales and the break-even sales. The required, what is the company's margin of safety? What is the company's margin of safety? So we need to remember the definition of the MOS, which is the margin of safety, actual or budgeted sales minus the break-even point sales. So we need to calculate the two amounts, the actual or budgeted sales and the break-even sales. The actual sales is given directly from the question. Look, the unit sales per month is 1,000 multiplied by the price, which is $30. This will give me the actual sales for $30,000. This is the actual sales. Okay. Then we need to calculate the break-even point sales. The break-even point sales. So this is exercise 5.8, and let's margin of safety is equal to what? Actual or budgeted sales minus break-even point sales. So the actual sales equals 1,000 units given in the question times the $30, which is also given in the question. So it is $30,000. $30,000. Okay. Now, what is the break-even point sales? This can be calculated also by two methods, the equation or the formula. I prefer the formula. So the fixed expenses divided by the contribution margin, what? Ratio. Why? Because we are talking about the sales, the dollar sign, the sales. So the fixed expenses here is 7,500 divided by the ratio. The ratio, which is the contribution margin divided by the price. Contribution margin is 30 minus 20 equals to 10 divided by the price, which is 30. Again, we have a ratio here. So be careful for the rounding. 10 out of 30. We have the full ratio. So 7,500 divided by 3 rounded equals to 22,500. 0.333. Okay, this equals to 22,500. For this case, if you like, just to confirm our number, if we use the equation, method, so the profits, or I will say or here, just to confirm our number, equation method, the profits is equal to what? Contribution margin, quantity minus fixed costs. Profit is 0. Okay, why? Because break even. Contribution margin is 10 Q minus $7,500. Okay, so the Q is equal to what? 7,500 divided by 10 equals 750 units. 750 units. Sales are equal to what? 750 times the 30, which is the price. Okay. So this equals to 22,500. Okay. So the margin of safety is equal to what? Margin of safety is equal to actual sales, 30,000 minus the 22,500. So the margin of safety is equal to $7,500. $7,500. I'm safe for $7,500. This is the margin of safety. Margin of safety for the company, which is how far I'm in the company. I do have an actual sales for 30,000, but the break-even point sales, which is 22,500. So I'm safe up to 7,500 before doing any loss. For number 2, what is the company's margin of safety as a percentage of its sales? As a percentage of its sales. So this was 1. Number 2, as a percentage of sales, we will say the margin of safety as a percentage, which means MOS, margin of safety, divided by sales. This equals to what? This equals to 7,500 divided by the base, which is 30,000. 30,000, which is the sales. This equals to 25%. 25%. This is the margin of safety as a percentage. Margin of safety as a percentage. That's all for 5.8. Okay. 5.9. Degree of operating leverage. 59. Ingberg company installs lawn sod in home yards. The company's most recent monthly contribution format income statement as follows. We do have sales, variable expenses, contribution margin, fixed cost, net operating income. Be careful about the percentages. The percentage of sales always represent 100%. If we have variable expenses for 40%, so the remaining will be for the contribution margin percentage. Okay. Number one, what is the company's degree of operating leverage? Number two, using the degree of operating leverage, estimate the impact on the net operating income of a 5% increase in the net sales. Number three, verify your estimate from part two above by constructing a new contribution format income statement for the companies assuming 5% increase in the net sales. It seems easy. We need to first to calculate the degree of operating leverage. Degree of operating leverage. So this is exercise 5.9. Degree of operating leverage. The degree of operating leverage, which is simply 1 degree of operating leverage, is equal to what? Contribution margin divided by net operating income. Contribution margin divided by net operating income. That's all. The operating leverage means then contribution margin divided by the net operating income. So this equals to what? 48,000 from the question. 48,000 divided by the operating income, which is 10,000. Go back to the question to see these numbers. The contribution margin for the whole company was 48,000. The net operating income was 10,000. So the operating leverage will be the contribution margin divided by the net operating income. This equals to what? This equals to 4.8 times 4.8 times the operating leverage. That's all for one. Okay. So simply contribution margin divided by net operating income. So this will give you the operating leverage. Number two, using the degree of operating leverage, estimate the impact on net operating income of a 5% increase in the net sales. We do have a shortcut, and this is what is the reason to calculate the operating leverage. So number two, we can calculate the increase or the change in the operating income directly from the operating leverage with the increase of sales. So we will say the change in sales, which is 5% times operating leverage, which is 4.8, this will equals to the change in operating income. Operating income. So 5% times 4.8, this will equals to 24%. 24%. So simply the change in the operating income will equals to operating leverage times the change of the sales, the change in sales, okay, times. Go back to the question. Using the degree of operating leverage, estimate the impact on the net operating income of a 5% increase in sales. We say 5% times the operating leverage. So the change in the income will be 24%. Estimate the impact of the net income for the increase. Okay. Number three, verify your estimate for part 2 above by constructing a new contribution format income statement for the companies, assuming 5% increase in the net sales, which means I have to prepare the income statement again, assume the increase in the sales for 5%, and let's see what will be the change in the net income. Okay. So we do have the current situation here, which is 80,000 $80,000 in sales. Total variable costs are 32,000. Contribution margin is 48,000. Fixed expenses 38,000, and then the net operating income is 10,000. Now, I need the change. I need this new situation. If we have 5% increase in sales, this will give you 84,000 increase in sales. Why? Because 80,000 times 1.05, 1 represent the 100%, and the 5%. So the increase or that new amount for the sales will be $84,000, which is 80,000 plus 80,000 times 5%, okay, which is 1.05, 1.05. The variable cost will also increase by 5% also. So 32,000 times 1.05, this equals to 33,600. The contribution margin, which is the difference between these two, 50,400. No change for the fixed expenses, 38,000. And the net income will be the difference between the contribution margin and the fixed cost, which is 12,400. 12,400. Now, what will be the change? I will continue here. What will be the change? The change in the change in net income will be what? 12,400 minus 10,000, all divided by the base, which is 10,000. If you need to know the change in a percentage, you need to go back to the base, right? So 12,400 minus 10,000, this will give you 2,400 divided by 10,000. This equals to what? 24%. Equals 2 or 0.24, which equals to 24%. That's all for 5.9. Okay. Verify, and we verified. Go back just to compare between the 24 here and 24 here, okay? So the verification from the income statement is still valid. The multi-product break-even point, the last maybe one. Multi-product break-even analysis. Lucido products markets two computer games, Claim Jumper and Makeover. A contribution format income statement for the recent month for the two games appears below. We do have two gains, sales, variable expenses, contribution margin, fixed cost, net operating income, and the totals for the company. What is the overall contribution margin CM ratio for the company? What is the overall contribution margin ratio for the company? This is simply the total contribution margin for the company, 30,000 divided by the total sales, which is 100,000, okay? So this is exercise 510. The total, number one, contribution margin ratio is equal to what? Contribution margin divided by sales. The contribution margin for the whole company is $30,000 divided by what? Divided by the sales, which is $100,000. This equals to 30%. 30%. So number one, what is the contribution margin ratio for the company? So we need to use the last column referring to the totals for the company. Okay. What is the company's overall break-even point in dollar sales? In dollar sales for the whole company, we need just to remind you about the break-even point in a dollar sign equals to fixed expenses divided by contribution margin ratio. If we're talking about more than one product, then we know we need to use the total contribution margin ratio. So number two here, we can say the break even in dollar sign, break even point sales equals to fixed expenses divided by what? Contribution margin ratio in this case, right? So the fixed costs is given to be 24,000 divided by the ratio that it is calculated in number 1.3 or 30%. This equals to $80,000. $80,000. The $80,000 is the sales amount to break even. Sales amount to break even, right? Sales amount to break even. The company's overall break even point in dollar sales. So we need $80,000 to break even. Verify the overall break-even point for the company by constructing a contribution format income statement showing appropriate levels of sales for the two products. Now, we need to prepare the same income statement, but for the new sales, which is 80,000, which gives you a net operating income of 0. Why? Because we're talking about break-even. So we need to prepare an income statement, right? And this income statement will give you the break-even point choice. Why? Because we have a break-even for 80,000. So this is sales Okay, here sales, total variable cost, no. Total variable cost, contribution margin or total contribution margin, fixed expenses, and net operating income, right? Okay, for the claim jumper, and the makeover and total. We will start with the 80,000 total. This is the important point. We are starting with the 80,000 in total for the whole company. So we have sales for 80,000, right? Okay. The sales mix, just to remind you about what is the sales mix, go back to the question. What is the sales mix for the question? Sales mix, which is the percentage for each product out of the total sales. So we do have 30,000 out of 100,000 for the claim jumper and 70% for the makeover. So this is called the sales mix. We will still use the sales mix to distribute the new sales. So we need here to just to remind you about the 30%, 70%, which is the sales mix. So out of 80, we do have $24,000 for the claim jumper, and 70% of the 80,000 will be 56,000 for the makeover. So we use the sales mix given in the question. Go back. Given in the question means the totals for the sales divided by the total of sale for the whole company will equals to the sales mix. We still use it to distribute the 80,000 sales total to break even. Okay. Now 70% of 80,000, 70% from the question. 70,000 out of 100,000 represent the variable expenses. Okay, so 70% out of 80 will represent the total variable cost. This equals to 56,000, which is 70,000 out of 80,000. But here, the 56,000 will be what? Will be distributed between the two products according to the percentage that we have already for the variable expenses. Go back to the question. We do have 20,000 for the first product, 50,000 for the second product. The total is 70,000. Now, first, we calculate the total variable cost to be 56,000, which is 70% or 70 out of 100 from the question, which is the percentage of the total variable cost, 70%. Why? Because the contribution margin is 30, if you like. Now, the 56 is distributed depending on these numbers, the 20, 50, and 70. So 20 out of 70 is the percentage for the total variable cost given to the claim jumper. 50 out of 70 is the percentage for the makeover. So we say 20 out of 70 all times 56,000. Let's calculate it. 20 out of 70 all multiply by 56,000. This equals to 16,000. 16,000 for the claim jumper. 16,000 for the claim jumper and 40,000 for the makeover. 40,000 for the makeover. Now, we have another way, if you like. Which refers to the sales of the claim jumper itself. 24,000, right? Times the percentage. Go back to the question. We do have 20,000 variable expenses and the sales were 30,000. So you can say 20 out of 30 percentage of the specific sales or the claim jumper sales. So we can say 20 out of 30 times the 24, which is valid. The percentage of, go back to the question, the percentage of the variable expenses is 20 out of 30, which is the sales. Variable expenses 20, sales is 30, so the percentage is 20 out of 30. Multiply by the new sales, which is 24,000. This equals to also 16,000. Similarly, we would say 50 out of 70 multiply by 56. This equals to 40,000. And then the answers. The contribution margin for the first one is 8,000. For the second one will be 16,000. And for the company will be 24,000. The fixed expenses 24,000 for the company, and the income is 0 for the company. 0 for the company, which is the break even. This was number 3. Verify the overall break-even point for the company by constructing contribution format income statement. That's all for 510. Interesting also. Okay, guys, I'll stop for the end of 510. Thank you.